Hello and welcome to the ASB Investment Podcast, a podcast that keeps you up to date on the market and helps you make smart choices with your investments. Before we get started, we should inform you that the views based in this podcast are those of the participants only. As individual circumstances differ, you should seek appropriate professional advice. I'm Jonathan Beale from ASB, and today Chris Tennent-Brown and Mairead Needham are joining me to provide an update on what's been going on in the markets recently. In this episode, we cover what happened in the first quarter of the year, the effects of lower interest rates, and also the impacts of the recent events in Christchurch. Hey, well, welcome, Chris, to this podcast. Good to see you again. I haven't seen you for at least a day, so good to see you. And you may have noticed we've been joined by someone else in our little studio here, which is Mairead Needham. So, Mairead, welcome to our little podcast group here. How are you?
I'm good, thanks, Jonathan.
Good. Maybe just for the people listening, maybe introduce yourself and say, what do you do at ASB, and maybe give us a little bit of background of where you're from as well.
Sure. So I'm in the investment strategy team within the asset management team and senior investment analyst in there. So I look after, along with the rest of the team, things like the asset allocation decisions, the asset class decisions, the monitoring of our outsourced investment management providers. So quite a lot going on, quite a diverse job. And yeah, you might know from my accent that I'm not a local.
Really?
Originally from Ireland.
Yeah.
Been here over 5 years, so I call this home now.
And whereabouts in Ireland?
So I grew up on the west coast, from in a county called Mayo. No one ever knows Mayo, so it's next to Galway. People know Galway, but lived in Dublin for years. Awesome.
Well, nice to have a fellow Celt. So I grew up in South Wales. So Chris, you're from Te Puke. I think you were there this week, weren't you?
That's right. Down visiting the old family area. But my life's largely been in Auckland, so I claim to be from Te Puke, but I guess I'd better call myself an Aucklander most of the time.
Hey, now, and lovely to have you here, Mairead. So maybe Chris, because last time we were talking was about the tax working group, and I think that one of the last comments you were hoping a few more people were going to read your report around the tax working group. Your mum had. What sort of feedback or comments have you had about the communications?
Oh, it's been really interesting. The first thing was when we were recording that podcast about the tax working group and would put out our paper. It was front page of the newspaper, but literally when we walked out of the podcast, we received the dreadful news about Christchurch. So, from a national perspective, I guess it's dropped down as the government focuses on other more important matters. But while we've been travelling and visiting clients over the past couple of weeks, there's been an awful lot of interest in what we think the proposed changes might mean, and a bit of relief with our view that there's no need to panic, and a lot of the stuff that we're doing will be business as usual until we know a bit more. So it's been really well received, and it's nice to know that people beyond my mum are reading
awesome.
and listening to my work.
Fantastic. So, I think maybe we'll touch on a little later maybe some of the impacts on investing that the awful events in Christchurch had a couple of weeks ago as well. So it's the last day of the quarter today, Chris, from an investment management point of view. And I think we were talking a few weeks ago about the quarter end of December where there was lots of volatility. And this quarter has been very different, Chris. You want to give us a bit of some of the highlights that we've seen over the last 3 months?
Oh, it's been an amazing contrast to the fourth quarter of 2018. And we've seen share markets recover remarkably. The New Zealand share market set fresh record highs during the quarter. Global shares have come back a long way. Global shares at one point were down about 20% from their peak in the fourth quarter of last year, and now they're within 5% of those peaks. So a really, really strong recovery. And I think the big thing that has changed, which is a key driver of this share market recovery, is the collective view on what central banks will do with interest rates. And late last year, we had the US Federal Reserve saying that they thought they'd raise interest rates more during the course of this year. Closer to home, we thought the RBNZ, the next move would be up. We thought it'd be a long way away, but we still thought the next move will be an interest rate hike. And now we've got the Federal Reserve in the States saying they've got a fairly neutral outlook. and the RBNZ's indicated that if they do anything in the near term, it's a cut. And in fact, we've changed our forecast to expect the Reserve Bank to cut now. Now, on the back of that, we've seen other interest rates, like long-term government bond yields, decline significantly over the quarter. In our case, our 10-year government bond is now below 2% in terms of a yield, and that's the lowest it's ever been. So a really remarkable quarter, and hopefully for clients, they'll see this flowing through to portfolios, which should have benefited from the share market recovery and the rally we've seen in bond markets.
And we were talking about it last time about there's lots of media about when the market's going down, and here you are talking about markets having a bit of a rebound, but I don't remember seeing too much commentary around that. The comments about markets getting devastated always make the headlines, but the steady grind back isn't as exciting, and the performance in bond markets is really unusual and a little bit more complex to understand. So yeah, we sadly get used to dealing with all the volatility. And then it gets quite quiet when markets are going well, and hopefully it means that investors can relax and enjoy seeing their portfolios recover. Yeah, I was thinking that with Mairead joining us as well. So I suppose, Chris, you spend a lot of time thinking about and looking at things that happen in the very short term or like daily events. And I suppose, Mairead, in your role with asset management, you're having a bit of a longer term view. Can you give us a bit of a view on where you look at, what sort of timeframes you look at? Yeah,
so we look at, in terms of the asset allocations within the portfolios, we look at that on a 2 to 3 year outlook. So we are seeing all this noise, and whilst we are looking at it and assessing it, we are trying to see past that noise, because you don't want to make decisions off short-term volatility. If there is going to be structural changes out of all this noise, then that may well impact on the portfolios, and we may make decisions on the back of that. But all this short-term volatility tends to have very little impact in terms of what we're doing with the portfolios. We believe in a long-term outlook, disciplined processes, and we are always constant in that approach. So, as I said, we will see this noise and we will watch it and review it, but it doesn't always have a direct impact on the portfolio.
That's a really interesting word to use there, like discipline. So I suppose I think a lot of people think because there's volatility in the market, an asset manager should make some changes now to react to it. And you're sort of saying, no, there's a disciplined approach to it.
Exactly, yeah, because it depends what these drivers are of the volatility. It may be, maybe Donald Trump has said something and that has spurred something. So that's not a structural fundamental change. That's just the market reacting off some comments. So if you don't stick to your disciplined processes, then you may make the wrong decisions, which will have a detrimental impact on the performance of the portfolio.
Interesting. And Chris, you're very in the detail about what's going on and making sort of outlooks as well. And I suppose one of the outlooks that you've been talking about was interest rates likely to increase, and then in the last week we've seen maybe a different feel from the central bankers. Yeah,
that's right, and it's really interesting because economists sound like the boy who cried wolf sometimes. We've been thinking interest rates should increase for such a long time now, and yet they just keep getting lower and lower and lower. And in the first instance, this is quite good for the short-term performance of bond funds, for example. But the longer-term issue is it's just one more thing keeping term deposits, which so many of our investors rely on, keeping them low. And so there's a number of interesting things there that just keep interest rates lower for longer seems to be the catch cry of the last few years.
And what are some of the things that are driving the Reserve Bank to suggest that they may even reduce rates?
Well, they're concerned about the slowing economic growth outlook. We were growing well over 3% a few years ago, and the economy's had a really strong run, and now it's growing more in the mid 2% range, so a slower growth outlook. And there's not much in the way of inflation occurring. And at the end of the day, that's what the Reserve Bank's adjusting interest rates for, is they've got their price stability goal. And if inflation's not forecast to be an issue, and there's downside risks to growth and in turn in inflation, we get into the situation where if they do anything, it's likely to be an interest rate cut.
we've even seen that in terms of what we've been doing with the funds. Recently, we made some changes in terms of the New Zealand bonds versus the global bonds, and we have slightly moved away from New Zealand bonds into global bonds on the back of that growth outlook, because that is a more structural, longer term impact on the portfolios. So we are making changes and based on the particular aspects that affect the portfolio.
So what you're saying, and I think sometimes customers think that, so if New Zealand bonds are low, well, I shouldn't be in those, I'll move out to something else. And what you're saying is we're still in New Zealand bonds, but you're reducing the allocation. Is that what you're saying?
Exactly. We're reducing it because they've had a really good run. 1 year returns on the New Zealand bonds have been around 6%, which for a fixed income asset class is pretty strong. So, maybe it's time to just cash in on that and move to other asset classes within the fixed income space that have brighter prospects without going away completely. Still got to diversify.
And you're still taking the risk profile of the portfolio into account, so you're not adding any further risk, or are you?
Absolutely. No, we do take the risk profile of the entire portfolio into account. So how the different asset classes play off each other. So not just within New Zealand bonds versus global bonds, but at a broader portfolio perspective as well. So you've got your global equities, your global property, your emerging market equities, your cash. So how do they all play together?
And Chris, we're hearing interest rates in New Zealand lower for longer. Probably should turn that into a T-shirt or something. But what could that potentially mean for sort of the New Zealand share market and the Australian share market, do you think?
Well, I think it's one of the key factors behind the share market going so well through the quarter. From an investor perspective, when we're out talking with people and I produce my forecast, which suggests that term deposit rates are going to stay incredibly low. For example, a 5-year term deposit is 3.6% now. Well, people will look at the New Zealand share market where there's a number of companies that are paying out dividends that are higher than that, and some of the utilities, for example, and be comfortable with that as an investment to try and generate a higher amount of income and hopefully some capital growth as well. So the low interest rate environment has been incredibly supportive for a number of New Zealand shares because of their high dividend characteristics. So they really tie in together. And when I think about my own outlook, we get caught up in talking about world share market volatility and what it all might mean, and Donald Trump and what he might mean. But I actually think the interest rate outlook, whether we are in this lower for longer interest rate environment for quite a lot longer, is really key to it all. If interest rates stay low like we're expecting, it's pretty supportive for share markets, and that's what's been flowing through the portfolios in the quarter.
And I think you can certainly see that in people's sort of appetite to take on a little bit more risk. We're certainly seeing people who've, relying on their term deposit to provide them with an income in retirement. That's really hard and really difficult if rates are aren't moving or actually going backwards. And looking for extra yield seems to be where people are looking, and is certainly driving the share market here in New Zealand.
And it's one of the nice characteristics we talked about in earlier podcasts, is that you can actually get a decent dividend yield here. The other thing which is in the mix over the past quarter, which is a bit of a negative for term deposits, is these proposals from the RBNZ to increase the capital held by banks. That we talk about that being an upward influence on rates, but we're talking about borrowing rates. If anything, it's another downward pressure on term deposit rates. So I think this low interest rate environment that's been supportive for shares and at the detriment of term deposits is probably going to hang around for a while.
And I think if I started comparing the two last quarters, you've had this volatile quarter, and then you've had sort of the following quarter with sort of markets being much more positive, and now interest rates being held longer, quite low. For the poor customer, that's like quite a difficult thing to sort of get your head around and start to understand. The last 6 months has been quite difficult and very different in periods. What were some of the things that you suggest to customers do in these types of periods?
Well, I think the most important thing is for people to focus on their own goals and their own time frame. And some of these movements are really hard to predict, and the volatility can be really distressing. But if you've got a 10-year time horizon, then to a certain extent you have to brace yourself for a few more bouts of volatility. And I think it's also worth not overcomplicating it. If you've got a well thought out plan and nothing's changed for you, then it's probably best to stick with it. And I'll use the bonds as an example. I remember back in September last year, dragging one of Mairead's colleagues along to a meeting because everyone was complaining about the bonds in the portfolio. Why do we have so many? Their returns are ridiculously low when the share markets are going so well. And here we are 6 months later, and thank goodness they were in there, because the bonds have not only really smoothed out the performance of the portfolio, they held it up during the periods of volatility, and they've actually added value through this year when bonds have rallied to even lower yields. So the discipline that Mairead mentioned is really, really important, and the diversified approach. Because on the day-to-day basis, you get all these crazy signals from markets, and over the longer term, the diversified approach really, really works. So getting back to the investors, I think at times like this we get really busy making sure our timeframes match up with investor timeframes.
Yeah. There's a huge similarity between sort of what asset management do around a disciplined approach. What's the long-term goal? What are you trying to achieve with the portfolio? Exactly the same as what the customer's trying to achieve. Why have you invested the money? What am I trying to achieve in the long term? And it's always going to be a bit bumpy as you follow that journey, but it's about having what are the decisions you're going to make? And the asset allocation process, I suppose, does that for the asset management team.
Absolutely, and it's pretty rare that you'll get all asset classes going up at the same time. So you've just got to be able to withstand these small bumps, like you talked about.
And the changes the team make, Mairead. So can you maybe just talk us through a little bit? So you make a change. How do you weigh out whether you're going to make the change or not make the change? There's some sort of benchmarks you've got to get over or levels to get over?
Yeah, Jonathan. So once the analysis is done and the model spit out that we should change the asset allocations to a particular weight, then we do a further analysis to find out if that change is actually worthwhile, because to make changes, you've got to do trading and there's costs involved with that. So we do take into account the costs of doing those changes. So if the benefit or the perceived benefit is going to be overwhelmed by the cost of making that change, then we do take that into account, and sometimes we don't make that change because the benefit is eroded. Okay,
so actually it's the benefit to the customer in making the decision. You might not do it because the cost outweigh the benefit of
Absolutely.
The upside. Okay.
And the customer is central to everything we do.
Fantastic. Now, it would be wrong not to talk about Brexit, Chris. We've got Mairead from Mayo,
yep.
Just outside Galway. I got that right? Okay.
Just north of Galway.
Just north of Galway.
Poor cousin.
I'll get my map out when I get home. So Brexit it's a comedy series, isn't it? What has been going on, Chris?
Oh, it's the gift that keeps giving in terms of bizarre political developments. I seriously thought that in the interests of political survival, something would have got across the line by now, but it seems we just keep drifting closer and closer to a hard Brexit. And there's all sorts of issues that politicians just can't seem to agree on. I'd have to say it's probably one of the worst periods in terms of a development that I've ever observed, and it's had an impact on UK markets. Obviously, over the last couple of years, the pound initially had a big drop. And in some ways now, I think expectations are so low. There's a potential when things, if they start to go right, that you could see some relief in asset prices that are related to the UK. But it just has been an amazing process.
And what do you think going forward is, so if they do leave and everyone agrees and then Theresa May exit stage left, what potentially could that mean for sort of global share markets?
Well, I think for global share markets, we've got to remember it's a small part of the overall global share market, and but it's a negative, and it's one of the reasons why we've seen UK assets under pressure. So over the last couple of years since the actual Brexit vote, from an economic perspective, it's in the opposite direction of what traditional economics would tell you is a logical thing to do. And likewise, Trump's trade wars are in the same boat. You know, at most university courses about trade, you'd be wanting to get into trade agreements and into trade blocks where you can lower barriers to doing business, and yet here we are going down the opposite road, and I think a lot of that negative news is already priced into the markets. But in terms of the outlook, I think things like a hard Brexit lead to a loss of potential growth and poorer economic performance, and that impacts company performance over the years ahead. But from an investment perspective, I think it's worth remembering, well, global shares are just a part of a portfolio, and UK shares are just a small part within that bit of a portfolio. And although this is a bad event, there's always bad events going on somewhere that impact some aspect of international shares. So when I was part of the global research team a few years ago working in Sydney, now, essentially, we would always trim a little bit off our global growth forecast because something would be going wrong somewhere in the world. And that seems to be one of the things going wrong in 2019.
And you mentioned Trump, you mentioned his name quite a bit today, and the trade wars, but China and US trade talks, and has that got positive implications or negative implications?
Well, that's one of the things that that has also helped markets this year. Last year, people were pulling their hair out with what Trump was doing. You know, he'd shut the government down. He was threatening more tariffs or increases in tariffs on with China, and yet this year we've chosen to be collectively optimistic about how things might pan out. We'll just have to wait and see there. But it does appear that markets have been optimistic that it's not going to be as bad as they were worried about late last year. And
just to pick up on the point you made at the beginning about the awful events in Christchurch and the shootings there, so that has had some impacts on investments, and we'll probably maybe touch on that now. So, Mairead, you're part of the asset management team and the investment committee, and there's obviously been a bit of talk about sort of investing in things like manufacture of guns or Facebook and Alphabet and those types of companies. Do you want to maybe give a bit of an update on what are some of the things ASB have been doing in the last couple of weeks?
Yeah, so that has definitely been forefront of the work we're doing over the past couple of weeks. So that there's two aspects to that. You've got the guns and the law changes that are coming up. So we're assessing how that's going to impact the portfolio. Obviously, if we're in investments that contradict the laws that are going to change, we will take steps to address that. And we are working with external advisors on that as well. And the other aspect is around Facebook, and ASB has been quite vocal in that area. And on the investment side, we are using this as an opportunity to engage with Facebook, potentially both directly, but also through our underlying investment managers. We invest through some pretty big global investment houses who have substantial shareholdings in these individual companies, and through them we will use their voice as well to hopefully make a change from the ground up.
I think that's one of the advantages, isn't it, that if you're using a very large global investment house like BlackRock that we use for international equities, their scale enables you to actually speak to them about, actually, we want to bring pressure on people like Facebook. So, little old ASB in little old New Zealand, actually, you can actually start to get some far-reaching and start to contact, and actually people coming together and New Zealand leading the way on saying, actually, there's some things here that are fundamentally wrong, and using the engagement process to do that, I think, is a really positive thing to do. A lot of the other debate is actually sell out of this stuff, and actually that's one way of doing it, but I think the engagement process is actually very strong and starting to actually sort of potentially have some impact.
Absolutely, and when you've got a seat at the table, you can make a change. So that is our view, that we're going to use that voice both collectively with our big investment managers, but also collectively with our peers in the industry. So there's a lot of conversations happening amongst various players in the industry. So if we all team together, the hope is that we can actually
make a difference.
Yeah.
Absolutely. And Chris, from a not maybe just maybe touch on it, but any potential outcomes from the awful shootings that maybe affect markets or the going forward with the outlook?
I think the points you've covered are really interesting, and to me it highlights how complex some of these issues about what you should and shouldn't invest in I wouldn't have thought until I saw the links people were making with Facebook, as Facebook being a logical stock that you didn't hold because of a horrible event like this, but it's clear to see now. From an economic perspective, it's always hard to know when to start analysing things like this. I was part of the team that tried to analyse the impact of the Christchurch earthquakes, for example, and calculate how much will this cost, and is it possible that we can fix it, and how will we do it. In something like this, I think the emotional impact and the impact it's having on people is really, really great. And we look at similar events around the world to try and understand, well, what are the types of businesses and industries that might get really impacted by this, so that we can help them or at least be aware of some of the challenges they have. And the logical things to be concerned about are things like tourism. What impact does it have on people's feeling of safety and security and desire to travel here? Education is another thing. People send their children from all around the world to get educated in New Zealand, and that's a big business where your perceptions of safety must be incredibly important for a parent. So those are things that we keep an eye on. And we can look at, unfortunately, examples of where this has happened in other parts of the world, and you often do see quite a big impact on sectors for a short period of time, but hopefully over the longer term, New Zealand's really strong attitude to this event come through, and even in places like Norway, which suffered a terrible tragedy a few years ago, they did bounce back over the subsequent year and turn the perceptions around. So hopefully that's what we'll see here.
Yeah, I never thought I'd see anything like this in New Zealand, but it's just really shocking. But I suppose one of the massive positives is the reaction of New Zealanders, and it's probably one of the reasons why you want to come and live in such an awesome country. So it's out of something that's been really horrible, you can start to see some real positives. But hey, I might just stop it there and just say, hey, thank you very much. I love working in the wealth business because it's always, every day is different. And so speaking to you guys about what's happened last quarter and what's happening potentially happening in the future is always learn something and always enjoyable. So thank you very much. Thank you, Mairead, for coming along and adding a different feel and style to it. It's been awesome. And thank you, Chris, as always.
Thank you.
Thanks for listening to this episode of the ASB Investment Podcast. If you have any suggestions for topics you'd like to hear, please contact us at podcast@asb.co.nz.